Hello, everyone. Welcome to our session on retirement with confidence, tips to maximize income and reduce taxes. Glad everyone could make it. And I'm your host here today. My name is Neil Kane. I'm going to be walking you through some of the functions that we have here on Zoom. In case you're not familiar with the functions, we have the ability to do Q&A. We are going to save a lot of the Q&A until the end so that we make sure that we get through all of the material so that you can get back to your work and not really extend this as long as it can possibly be with some of the questions that we get. But please feel free to utilize the Q&A. Additionally, you have the ability to toggle on closed captioning. Feel free to toggle on closed captioning. You have the ability to do that right in your Zoom functions. But those are some of the questions that we get asked. The other question is, can we get a copy of the slide deck? Of course, we'll be sending those out to you. And then anybody that wants a recording of this presentation will be able to get that. I'll share with you a QR code for you to do that. We're going to load this right onto our YouTube channel, and you'll have immediate access to the recording. So hopefully those are all the questions, those preliminary questions that you might have. I'm going to get right into a quick introduction of myself. If you haven't attended one of our presentations in the past, my name's Neil Kane. I double up as a chartered federal benefits consultant. Additionally, I'm a certified financial planner. So the idea is to bring you a lot of concepts that are related to your federal employment, but additionally related to outside financial planning strategy. So that's going to be what today is about. Additionally, I'm local to the DC area. I grew up in Rockville, attended Towson, finished up at Georgetown, and I've been in the industry for almost 20 years working solely with federal employees. So hopefully this is an informative session for you guys, because what we're going to really be trying to knock out and really get you to understand is how things have changed, right? A lot of the advice that you're being given is either built around old thinking or doesn't really tie in the federal side of things in terms of what you need to know as a federal employee and whether a recommendation or strategy makes sense for you as a specific group. So we're going to help you build a plan on information that's pertinent to you and pertinent to really where we are at with the entire tax code and things like that. So hopefully that makes sense. Let's start off with what we talk about the old paradigm. So when we talk about the old paradigm, we really got to talk about what your old system was. If you don't know about the CSRS system, let me tell you, it was a pretty good pension system. My grandfather retired on the CSR system. He was a longtime employee of USAID, and he retired with 80% of his final salary. That's just the way it was. And most of those federal employees really did not rely on their TSP. In fact, my grandfather had hardly nothing in his TSP. There was no matching that occurred in the TSP. When he got started, there was really only the G fund and the C fund. There was very little adjustments that you could make to that. So it wasn't really a plan that a lot of people participated fully in. And for that reason, you relied a lot on your pension. The pension that was given to you tracked the CPI index, which is essentially the inflation index implicitly. So when inflation was at 5%, you would get a 5% increase to your pension. That's just the way the old days were. Additionally, the mindset was that you would be living on some lesser income. So therefore you would be in a lower tax bracket, right? Because you didn't have a lot of money maybe in your traditional plans. At that point, your TSP, you really weren't living much on besides just your pension. Okay. And so given that lower tax bracket theory, tax deferred investing was really suggested as the best method to investing for retirement. So what's tax deferred investing? That is using your traditional TSP. At this point in time, Roth was not around. Okay. So Roth is after tax investing, tax free investing. So we're going to talk about the differences between those two today. But let's really talk about what the new paradigm looks like. Well, the new paradigm looks like number one, folks are living way longer than what they were back in that old paradigm. In fact, the chances of someone living to age 90, right, are almost 50% in terms of a joint couple. Additionally, that pension that kept track with inflation no longer does that. So now you have got a pension that only keeps track of inflation minus 1%. So what does that essentially mean? If inflation is at 3%, you're getting a 2% cost of living adjustment to your pension. Now, you may not think that that's really a big deal, but it is a big deal over a long retirement record, right? Or track record. So you're talking about a 30-year potential retirement um, timeline. You're talking about a 30% reduction of your purchasing power over that time. So what may have seemed like you were only pulling out $20,000 from the TSP might end up something like $60,000 from the TSP when it's all said and done, because essentially your withdrawals start to get larger and larger. So you'll see if you thought, okay, my withdrawals were going to be flat, right? I was going to start off at $20,000. Well, actually, they're going to look more like this, right? Not the best drawing, but they're going to be increasing over that time frame. So that is a big aspect to a lot of things that federal employees miss. They miss the fact that the cost of living adjustment isn't going to increase one for one. The other is investment reliance, right? So retirement in this day and age is mostly self-funded, right? A lot of withdrawals happen from that TSP over folks that are in the FER system. And essentially, that's because of inflation. Inflation is eroding that purchasing power. And we've got a little metric there to show you that the purchasing of $50,000 essentially feels like half of that after 25 years. The other part of your system is Social Security. And there are issues in the Social Security trust, essentially. And as we talked about in other sessions, that is an underfunded area. You are looking at a system that, if it isn't fixed by the year 2034, will most likely be out of money. Now, what that means is you're not necessarily going to have no Social Security. You would likely have in that scenario 25% less benefits. It's hard to make assumptions on this at this point in time, but that's what we're probably looking at in a worst case scenario, 25 to 30% less benefits if that trust were to run out of money. The other aspect that we have working against us is the higher increase of healthcare costs. So we not only have higher increase of healthcare costs when it comes to just normal medical insurance, right? Additionally, in retirement, you're likely going to be expected to pick up Medicare Part B, which is also an additional increase to your insurance premiums. But the reason for that is in retirement, if you don't get Medicare Part B, your FEHB will actually only cover to what Medicare was going to pay, which is 80%. That would essentially leave you with 20% plus the co-payments, co-insurance. So a lot of people do end up picking up Medicare, and that's an additional expense that you may not have thought about as a federal employee on top of your FEHB. The other thing is long-term care. Long-term care is an expense that's rising much higher than inflation. When we talk about long-term care, we talk about essentially coverage that isn't offered by your FEHB, federal health insurance. It's not offered by Medicare Part B either. The first 150 days are subsidized by Medicare Part A in terms of care. But after that, you're really on your own for the full amount of what assisted living would cost, whether that's someone coming to your home to help you, whether that's you being in a nursing home, those types of expenses. And they're astronomical in terms of what they cost. Okay. The last aspect of a new paradigm is going to be taxes. Taxes are widely expected to rise. We're going to be talking about that here in the next section. But the status quo of tax deferred investing, where essentially you thought, hey, I'm going to pay lower taxes in the future, that may not exactly jive. So we're going to give you some reasons around that and some things that you can do to think about or take advantage of some other kind of thinking around taxes. But first, before we do that, let's talk about your pension and your benefits very quickly. So when we look at the computation on the new system, FERS employees, right? We look at two different calculations of this. One is if you're retiring under the age of 62 or 62 with less than 20 years of service, it's a 1% factor times the year of service times the high three average salary. That's about 50% of what the CSRS was. Okay. In addition, though, there's a different calculation. If you're able to hit 62 with 20 years of service, it's a 1.1% factor. So essentially, what you're getting there is if you can get to the age of 62, you are getting a 10% bonus by getting that 1.1% factor as opposed to the 1% factor. Okay. So that is a pretty significant increase if you're debating on retiring at 60 or 62. Now, if you're fortunate enough to go at 57, your minimum retirement age for most folks, you may not want to hang on for that 10% bonus. But if you can get a 10% bonus on all your years by just working another one or two, a lot of times that's a well worth thing to do. And essentially what you're doing is you're working another 1 or 2 years, but you're getting credit for about, almost 3 to 4 years in those calculations. Okay. So what we talk about as well as buybacking time, we're not going to talk too much about federal benefits here. These are some of the slides from our federal benefit presentation, right? So I'm not going to get into the bottom bullet points there, but if you do have some questions, we can take those after the presentation. We'll talk about that cost of living adjustment really quickly. I wanted to give you the exact calculation of how this is calculated for FERS. And essentially, it does not keep up with inflation. It does not accrue until 62. So if you're retiring at 57 or 60 or any of these ages before 62, you're not going to get a cost of living adjustment. And essentially, you're not getting the full increase of the CPI index, which tracks inflation. Most of the time, the CPI index is going to be somewhere in the threes. And if it's at 3% or higher, you're getting 3 minus 1%, which is essentially going to be 2. Now, obviously, if this CPI index is at 5%, you're going to get 4. It's always going to be minus 1 in that calculation. And that's likely what you're going to get or you should project for your retirement, which is a disadvantage over that CSRS system. You're with so far with me? Good. All right. And if you got questions, feel free to put them down. I'll field them and make sure that you get those answered. So we talked about Social Security being underfunded, and we talked about what our thoughts were around what the worst case scenarios could be. Here's kind of that slide to discuss that, right? The underfunding that's going on in terms of Social Security is impacting the trust fund. That trust fund is drawing down and is widely expected to be bankrupt in the year 2034. if there is nothing done to the Social Security trust in terms of what is being collected. Now, does that mean that you would have no benefits? No, it does not mean that you would have no benefits because, again, the majority of Social Security benefits are being paid out by those that are working, and there will still continue in the year 2034. But it's that underfunding portion that's being taken out of the trust fund, and that's why that trust fund's drawing down. So there's some solutions that have not been passed. This is yet to be seen what will happen, but this is our take on this. This is actually on CNBC's take. And this is essentially what we're bracing for if nothing is passed, which is why you want to do some of those worst case scenario analysis when you're planning for your retirement. Okay. So I got a question that came in. I want to make sure that your questions get addressed. And the question that Virginia basically asked, and I just want to just allude to it, is this only for first employees? Absolutely not. So we just ended the benefits section. Thanks, Virginia. What we're going to get into from here on out affects everybody. Okay. We're going to talk about tax rate risk here next. So, tax rate risk. What is the deal with taxes? Why do people think taxes are going to go up? Well, first of all, we can examine the old tax brackets, which are actually here in green, and we can examine the new tax rates, which are here in blue, and we can see the differences. There's some subtle differences in terms of tax rates, but what I think is the biggest differences is the range of income, right? So when we look at, let's say, the fourth bracket, the range of income was only about 75 to $70,000, right? Now the range of income encompasses $180,000. That's supposed to be a zero. Okay, so $80,000. That's a big range of income. So folks that are in this bracket have a much bigger wiggle room than what they used to have prior to the 2018 changes, right? Because as you notice, the fifth bracket's a pretty extreme difference on both of these regimes, right? You're going up to 32 in the new brackets from 24 to 32. And prior to that, you were going up from 28 to 33. Those were the most significant changes to the income tax rates in terms of income. But now you got a lot more margin of error before you face that 30% or higher tax rate. So that's why we are stressing that these tax rates from a rate perspective, from an income perspective, are definitely more advantageous to you as a taxpayer, and that these current rates are not expected to last forever. In fact, the current rates are expected to expire in 2026 and then go back to the 2018 or prior to 2018 tax rates. Now, some of these income ranges will change and adjust higher, but the bands in terms of sizes and the rates will be what you have here over in the green when these expire. Now, will they expire? Will Congress let them expire? Will there be a shift out to 2030? That's anybody's guess. What we have to start thinking about is, well, regardless if they do over the next, let's say they get extended another 4 years, okay? Where are we in terms of tax rates looking at a broad history of rates going back to, let's say, World War II, right? 1940s. So back in the 1940s, we have the ability to go back to the rates. We have the ability to look at couples that were $100,000 or $200,000. And this is assuming inflation, right? Inflation of the tax brackets, inflation of the income. And we have the ability to look at what the tax rates were for each of these groups. And as you can see here, the tax rates that we set forth here in 2018 are amongst the lowest tax rates for this group of income earners that we've ever seen. right? When we look at the 90s, right? The 90s were actually made up of a time period where this time period, not to really get it political or anything, right? The balance budget was balanced at this point, right? So we had higher tax rates. The tax rate for someone that was paying $200,000 in joint income was close to 28%. Now that's about 22%. Okay. So if you think tax rates are high right now, think again. And we encourage those to think outside the box here. This old paradigm of I'm going to be paying low tax rates later on, we just don't think is going to happen. So there's a couple reasons for that. One, unfunded liabilities, right? Right now, there are a extreme end of unfunded liabilities. 96% of every tax dollar that comes in the US Treasury goes out to pay for only four things. That's Social Security, Medicare, Medicaid, and the interest on our national debt. Now, interest on our national debt is a big deal. Treasuries are essentially liabilities of the federal government. There are a ton and ton of treasuries that are owned internationally. Think China, Japan, all these countries own our treasuries. And ever since our interest rate went up from a Federal Reserve perspective, the interest rate on this debt has ballooned in terms of the payments, and it's become a lot more difficult to service. So when you start to think about tax rates, right, and we start to look at the rest of the world, most developed countries actually have a much, much higher tax rate than us. Okay. You look at Europe, it is significantly higher than us. So as countries start to mature over time, the debts grow, the services grow, the programs grow. So those become more difficult to service. And you eventually start seeing tax rates that are a lot higher than some of these more emerging countries. Now, we've been around for a couple hundred years. I wouldn't consider us an emerging country. We are really approaching that mature kind of country. And I think the idea of higher tax rates in the future are are honestly likely, and we have to start planning for those in terms of retirement. So here's another chart for you that was just kind of going to be our last tidbit here on this tax section is according to the congressional office, right? In terms of the budget office, absent of any spending reduction, right? These are the levels that taxes would need to go to keep the US solvent, right? When you got the lowest tax bracket at 10% right now, the middle tax bracket is 24%, and the highest bracket is 37%. Here you kind of see those estimates of where these would need to go to by the year 2050 and 2082. Now, again, we're not here to do any scare tactics. This is what has been projected. This might be a little bit extreme as what you're thinking, but I think the long story short of where we can get at is tax rates are most likely going up. So what can we do about that? How can we plan? Okay. Well, we can start to think about how our assets are going to come out. How are they going to be taxed? Right? And what are the best investment plans or investment types to use to plan for potentially a higher tax regime? So there are three main types of investment accounts in terms of how you're taxed. The first type of account is what we call a taxable account. These accounts are non-retirement investments, investments like bank accounts, brokerage accounts, stocks, investment accounts, mutual fund accounts that are not held within a retirement plan. Okay. These accounts tax you on dividends, capital gains, interest in the year that you make that money. Okay. So let's say I got a mutual fund account with Fidelity, right? Non-retirement. I get some capital gains distributions or I sell some stocks or mutual funds. I have to pay taxes on that this year. along with the dividends and other things that they distribute. Now, the yellow box here, a tax deferred account. This is like your TSP traditional. Okay. A TSP traditional or a 401k traditional plan or a traditional IRA or annuities, they essentially, these types of plans allow you to prolong the taxation to a later date when you, and that later date is when you start withdrawing the money. Most of these plans don't allow you to begin withdrawing money until you're retired. Let's call it, you know, late 50s, 59 and a half for the most part, right? And essentially, that's when you start paying the taxes on it. That's a tax deferred plan. And these plans are really considered traditional retirement plans, AKA traditional TSP. Now, the third and last is the tax-free bucket. These are going to be examples of your Roth plans, Roth TSP, Roth IRA, life insurance, after-tax money that grows tax-free for life. All right. We throw life insurance in that category because life insurance isn't taxed. It's not a technical investment. A lot of people or financial advisors might use this as an investment or recommend. We don't. But the point is, tax-free uh, life insurance proceeds are in this category. And your FEGLI life insurance as a federal employee is a tax-free benefit to your beneficiaries. Okay. So let's compare these and the growth that we see over these plans using an assumed $100,000 investment, 6% growth rate, and a tax rate of 28%. Over time, you'll see that the best investment by far is the tax-free investment. There's absolutely no comparison to that because there is no hand in the cookie jar, right? Once that tax is paid up front, that money begins to grow unrestricted without any sort of subtraction from it over time, with any sort of variability in tax rate. That money then is absolutely the highest value in the end to your beneficiaries for you to use at the end of your life, whether it's for long-term care, you didn't buy the insurance, that tax-free growth rate is by far the best. So how do we want to think about this now in terms of withdrawing? Okay. Because the first pitfall that we see for federal employees when they come to withdrawing money from their investments, specifically in retirement, is a lot of folks are under the thoughts that they will withdraw from their Roth first. And in reality, that is the furthest from the truth. The non-retirement account is 100% going to be your first account that is spent first. So essentially what you're doing is you're taking those non-retirement assets first and you are making withdrawals from that. Why? Because they don't tax you as income. No income is being actually taxed when you're withdrawing funds from your non-retirement plans. So that is essentially your best bet. Okay. Your best bet is to withdraw those funds because it's going to reduce ongoing tax liabilities because you're only going to be taxed as dividends and capital gains in this. And when you withdraw capital gains, it's a different tax rate. It's not taxed as income. Um, the let me discuss this part real quickly. So when you sell off an investment account and you are withdrawing from, let's say, a non-retirement account, the withdrawal that you make from that account is not taxable. It's the sell of investments in that account that creates taxes. However, let's say you have a mutual fund that you bought for $80,000 and you're selling that for $100,000. You're only paying taxes on the difference between 80 and 20 and 100,000, which is a $20,000 capital gain, which gets taxed at a different treatment than income, likely 15%. Okay. So by withdrawing from these investments first and investments that don't affect your income, you can then work on other things like Roth conversions. You can temporarily reduce your income in your early years of retirement by drawing on non-retirement investments first. I'll get to this idea here in a second. But the next order of withdrawals are then going to be from your traditional. All right. By withdrawing from your traditional investments, it helps reduce the required minimum distribution. It enables Roth assets to grow longer in this scenario. You might be asking, required minimum distribution, what is that? A lot of you know what that is. I'm going to explain that in the slides coming up. But in terms of order of withdrawal, we want to withdraw from those tax deferred. And then lastly, we want to withdraw from our tax-free investments because we want to give those investments the most ability to grow. Okay. The growth is unparalleled in the Roth investments versus the other two that have taxable growth associated with them. So the benefits of using your assets in the right order are huge. This gives you the ability to kind of see the investments after required cash flows in retirement versus starting with Roth first or starting with those taxable funds first. Okay. One draws you completely out of money by the end of your life. One leaves you with money left behind. Okay. So you really want to consider the order of withdrawals, not just where you're withdrawing from. That leads us to a totally different conversation that we can have about the TSP. But one of the downsides that you'll see in the TSP in retirement is it doesn't allow you to choose the investments you're withdrawing from. You can choose from traditional or Roth, but you cannot choose from G fund or C fund or vice versa, right? And in a down market, that can hurt, right? So I'll talk a little bit about that in the sequence of withdrawals, but essentially, pitfall number two is large financial losses take longer to gain back than they were to lose. For instance, if your portfolio is down 40%, you'll need 67% rate of return to break even, because there's a lower pool of money or a smaller pool of money in that scenario. And this shows you the years that it takes to break even, assuming a return of, let's say, 8% on the market. It would take you 6.6 years to recover that 40% loss. So that's pitfall number two, right? We're going to talk about pitfall number three here in a second, but once you're approaching retirement, one of the things that you need to know is, and I saw some questions come in, hands raised. I want to make sure that we get through some of this material, but I can take a few questions right here, just a couple, just so it doesn't seem like I'm not answering these questions. Can you spend Roth TSP last versus traditional? Absolutely. Yep. So you have the ability and power to do that within the TSP. You just don't have the ability to pick on the funds. The next question, I'll take one more that says, I had been led to believe that any TSP withdrawal would be pro rata, IRA, Roth, and therefore we would not choose to withdraw or one or the other. That comes from Randall. Randall, that rule was changed and modified in the TSP Modification Act and rules just a few years ago. It now gives you the ability to toggle between traditional and Roth. It just doesn't give you the ability to toggle between fund to fund choices, which is going to be important as well. So I'll take some more questions here in the next, but I want to get through some material before we do. All right. So imagine you're in retirement, guys, right? Imagine this is your first year of retirement. How does your income come to you? Well, in the first 4 weeks of your retirement, really the only thing you should expect is your annual leave check. So your annual leave check is going to be all of that annual leave that you did not take, that you had roll over. You can roll 240 hours from 1 year to the next, then it's use or lose. So the maximum you can actually take, the maximum if you didn't use any in a normal employees kind of average is 448 hours. If you didn't take any annual leave for 2 years, that's what you would get. And essentially that would get paid out to you in that first 1 to 4 week period as a lump sum. Now that's going to be taxable to you as salary. Okay. Then you're going to have access to TSP withdrawals. Typically, the TSP freezes your TSP withdrawals for 30 days after your retirement. Weird, but that's what happens. We put 4 to 8 weeks so that you know that there could be an extension. It's usually 30 days. We're putting a little bit of extra time on the end of these just to make sure that you're planning for the worst. Okay, but it's 30 days. Okay. Then what you start to receive is what's called an interim pension. It's not your real pension. The federal government's got to make their final adjustments on your pension. So what they're going to do is they're going to receive an interim pension. That may not be your full pension. So you might be living on those first 4 to 12 weeks on something that is not your full pension. What will then happen after those 4 to 12 weeks are over is you'll start to get your full pension, and any unincluded amounts in that interim pension that you were supposed to be paid will actually be given to you as a lump sum right there. So you'll be made whole, let's just say, for lack of better word, right? But what does this mean? It means that you might be on lower income on those first couple years of retirement, especially if you're not drawing Social Security just yet. Now, you may be retiring before Social Security starts. You might be retiring before 62, and in that end, you'll get a supplement if you've completed 30 years of service or 20 years at 60 and 20. But if you haven't, you're not getting that either. So that means you're going to be drawing on more TSP than what you might think you may be needing. And in that case, you have a scenario that would be detrimental if we got a down market in your first couple years of retirement. So there's a little phenomenon called the sequence of returns. So sequence of returns essentially means that it is far more detrimental to an investment portfolio to see heavy down years in your first couple years of retirement while you're withdrawing on an investment account versus the latter, versus a good market in your first couple years of return. Imagine your first couple years of your retirement being really good. Let's look at the left chart here, right? And if I can draw on it and get my mouse to work, let's imagine that we have a 5% average return over the first, call it 15 years of your retirement. Let's imagine though the first 3 years are awesome years. The market takes off, shoots up, lifts your portfolio up while you're withdrawing on it. And essentially, within the first 10 years of your retirement, you've had an excellent market, right? In that scenario, you're going to actually have more money than what you had going in, even if you're withdrawing about 5% of the account. Okay. Let's assume that it's the exact opposite. Let's assume that now, instead of having great years, you have awful years, your first 3 years of retirement. You're withdrawing funds. You don't have the ability to withdraw from the G fund or the C fund. You got to do what's called a pro rata withdrawal from those investments. So if the market's down, you're selling off some C fund. You're selling off some S fund. You're selling off some I fund if that's what you have. That's a very difficult scenario to a retirement plan. And that's where you can really blow up a retirement plan by making some heavy withdrawals when investments aren't doing so hot. That is pitfall number 3, sequence of withdrawals. Okay. So what can you do to combat that? So there's a method called the bucket strategy, and I want to explain this bucket strategy as simply as possible. Think about your retirement plan in buckets and in terms of order of use. When are you going to use these particular pieces of investments that you've carved out? So, for instance, your G fund, right? That's essentially a very short term bucket. It's a bucket that is something that will not be moving around. If the market goes down, it's not going to drop. If interest rates go up or down, it's not going to affect its value. It might affect its earning potential, but it's not going to affect its value. Okay. This is a proper investment for a short-term bucket, right? And imagine if you're in retirement and you're withdrawing from the short-term bucket and the market has gone down for the first 3 years and you've built out this short-term bucket that you're withdrawing from that has really not moved around at all. Are you hurting your retirement plan by withdrawing from that bucket? No, you're not. But if you're withdrawing from the whole account, yeah, you are hurting from that because that means your long-term bucket that is down 30, 40%, you're actually withdrawing from that and selling investments at a loss. So this approach, which is the bucket approach, is a very important piece of shielding those investments that are more middle to longer term investments from being sold in a scenario where the markets have taken a beating, all right, when markets are down. So when we recommend an investment path or solution for a particular client, we're recommending that they build out these short, middle, and long-term buckets that are going to be unaffected by withdrawals, right? And we're going to be replenishing these buckets during over time so that they have these short-term buckets to withdraw from in difficult times that don't impact the long and midterm buckets. Okay. I hope that makes sense. The unfortunate part, right, is that for the TSP doesn't, it allows you to build these buckets, but not use these buckets in this way. And that's the issue that we have, right? But as long as you get the concept, these are things that you can begin to do for yourself on the outside when you get into retirement, or if you approach retirement and you want to begin carving these out so you can use them that way. Okay. And what we want to think about in terms of filling our short-term buckets, again, is investments like maybe the G or F, right? Or F, because it's got some variability, maybe some of that goes into the midterm bucket, right? But we want to carve out investments that do not bounce a lot or have a lot of variability. Those need to be in our short-term bucket. The investments that have a lot of variability, like the CS&I, right? A lot of risk associated with them. Risk means volatility, by the way, guys. So volatility is being measured by risk is being measured by volatility on this chart you have here. Anything that's registering above, let's say, 15% in volatility, those want to be in our long-term bucket. Anything that is really not bouncing around much, definitely the G, maybe the F. Some of that can be in our short term. The middle bucket can be some of these hybrid type investments, right? That have a various allocation to them or more of a diversified or different approach to them that makes them more of a middle bucket. Um, I'm not going to get too heavy on this slide because this is more about the concept. Obviously, you could see how these different investments like the C and I have returned more or less on various risk factors, which is eye-opening or eye-popping in itself. But because I don't have time to go through all that, I'm going to jump into required distribution. So we talked about required distributions, and I got a boatload of questions that just came in, and I know I will answer every single one, but I want to get to the end of this within the hour, so I can let some of you jump off that I know have more of a time constriction. Pitfall number 4 is required distributions. Why is that a pitfall? I'm required to withdraw in my 70s. How is that a pitfall to me? Well, it's a pitfall for various reasons. Imagine if your required minimum distribution age is 73. At the age of 73, you must now begin withdrawing funds from your traditional plan. And by the way, guys, as you have more questions and these questions start to become more personal, this format might not be the best place to answer those. I'll be looking at everyone, right? But if you have individual questions that you want to get answered one-on-one, I'm going to give you a QR code to get a Zoom one-on-one meeting that will be complimentary for your first meeting. So hang on with me. There's only about 15 more minutes to go till I share that. I'm also going to share the YouTube channel that we have where this video will be posted on. So please hang on. But let me talk about this fourth pitfall, required distributions from traditional plans. So as federal employees have gravitated towards having their pension, Social Security, and dumping a boatload of money into these traditional plans, which now have matching, right? Back in the old paradigm, CSRS, you didn't have a match. Now you have a match of 5%. You're seeing some uberly large TSP traditional savings plans these days. There's more $1 million TSP traditional folks than we've ever seen. However, at in your mid 70s, out comes the requirement for withdrawal. Okay. Early 70s for some. And this distribution begins right around 4.5% of this base. And that withdrawal increases every single year. The percentage increases every single year you age. And when you start to get out to your mid 80s, you're taking out 10%, 15% until that account is fully distributed. And the issue that you have with this and why it's pitfall number 4 is that on average, the large majority of federal employees cross into higher tax brackets when these begin. The large majority of federal employees cross into higher Medicare brackets when these begin. Okay. Remember, Medicare Part B is an additional insurance that you will likely add on in your mid 60s at 65 if you're retired, if you don't want to be on the hook for 20% of your healthcare premiums, right? That's income based. So the premiums are actually based on what you're earning. So a required distribution is taxable income, goes on your tax return as income, and will affect your medical insurance. All right. And the last thing I'll say about it is who wants to withdraw? Let me just throw an example, $50,000, $60,000 if you have $1 million plus TSP, when you only need $30,000 and affect your health insurance and your tax rates. That's not a fun situation to be in. So out comes a potential solution. And that solution is your Roth plan that literally resides in your TSP now, or it didn't. So be happy that now you have that option to invest in that TSP Roth. Okay. Because the TSP Roth gives you all of the benefits of the tax-free growth. And I'll go back to the slide. Does not require for you to take out an RMD. So you can reduce your RMD, expected RMD in the future that might have popped you in a new tax bracket, might have popped you in a new Medicare premium by having more of a balance in your retirement plans. Not everything should be traditional. And that means a lot of people that have pumped a ton of money into their traditional, because think about it, right? Your traditional TSP is always going to get the match. even if you use all Roth for your contribution, the government will always put the matching deposit in the traditional plan. So you're always going to walk out with dollars in that traditional plan. It doesn't even matter if you put everything into your Roth TSP, right? So what we need to start looking at is the effects of the required. I'm getting tons of questions, so I'm going to get to all of them, guys. Just bear with me. What we need to look at is the effects of this required distribution on your retirement plan income bracket. And then lastly, we got to look at that Medicare bracket too. Um, when we do, an income analysis, right? Taxes are a significant component of a retirement analysis. It's got to be. It's not just a probability if you're going to run out of money or not. It's got to look at all of it. All right. So this is a quintessential kind of income that a federal employee has, right? You've got Social Security, you got pension, which then brings out your adjusted gross income. By the way, your Medicare premiums go off of adjusted gross income. Your tax bracket goes off of your taxable income. So Medicare premium estimations don't go off of any deductions that the IRS gives you off of your income number. So standard deduction is likely going to be what your deduction is. Most people don't itemize the deductions anymore because those have been cut down and there's some caps on them. So the standard deduction is likely going to be what you use. So in this case, right, the taxable income would be $76,000. Just giving you an example. This would put this federal employee in the 12% tax bracket in retirement, or so they think, right? However, they haven't thought about their RMDs yet. So if this federal employee is projected to have $77,000 in taxable income, 109 of actual adjusted gross income, but after the beautiful deduction you're only paying taxes on the 77. You might think, okay, that's 12% tax rate for me. However, you got money in your traditional TSP, and with a little bit of growth over 11 years, maybe you withdrew some. That's why it grew little, right? We're not going to get into that too much right now. You're going to have a pretty big RMD offset, 690,000 bucks. And that is likely going to hit you with a higher tax rate. It's just what happens in retirement for so many federal employees. And ultimately, what then happens is tax rates on interest, dividends, capital gains, short term, all of the investments that you were holding outside of your retirement plans now also experience a higher tax rate too. So these are issues that the average federal employee is going to find. And for that reason, this is where we recommend the Roth. We recommend contributing to your Roth TSP as much as you can, especially if you're in the 24% tax bracket or less. Make those contributions if you can to the outside Roth IRAs. Those help too. You can also convert your TSP traditional plans to Roth plans if you're of the age of 59 and a half. You can't do that before 59 and a half, unfortunately. But the TSP will allow you to convert what you contribute to traditional and convert that out to Roth when you hit 59 and a half. That must be done outside of the TSP though, cannot be done in the TSP. So these are some ways to combat too much traditional, creating too much tax burden later. This is how you combat that. These are some tools. Okay. So this is the how you combat through a Roth conversion. So let's back the slide up. Imagine, right, you're at $77,000 in retirement. You've got $500,000 TSP plan. Your days of lower taxation is limited. You see the writing on the wall, right? You've got $17,000 of buffer in your 12% tax rate before you go to 22 in your 70s. Why wouldn't you convert out at 12%? So this is a plain example of someone converting while their tax rates are lower, right? And what's going to happen in this example is they are going to lower what their balance was at the age of 73 when their RMD starts, and they're going to have a lower RMD. They're going to have a lower required distribution that keeps them in their tax bracket. Okay. This is proper tax planning for the future. It's not just looking at now. I know everybody wants to live in the present moment. That's the big kind of fad these days. And I'm an adopter of that. But when it comes to financial planning, you've got to be looking out to the future. All right. And one might say from the previous slides that we had that the overall goal should be, oh, well, you're telling me everything should be Roth then. No, it's all about balance, guys. If we can create an RMD that is low enough to fit within your tax bracket in retirement, low enough to fit within your Medicare tax bracket in retirement, so that doesn't go up, we have now achieved the holy grail of financial and proper tax planning, and we've kept you in these brackets thick and thin, and built out a Roth plan that has no RMD and will have no taxes for your future beneficiaries as well. Okay. I had to show the Medicare brackets just so you would see them. I talked a lot about Medicare, had to show them so you'd see them here. These are those Medicare premiums. So wanted to at least give you guys an of what those cost and how they change as your adjusted gross income goes up so that you could see those. I mentioned this already, the sweet spot for Roth conversions or paying taxes right now, we believe is at 24% or less. We already talked about the size of that bracket. We already talked about the fact that there's hardly a difference between the 22 and the 24. God forbid you go from 22 to 24. That's not a big deal. If doing conversion sent you at 24%, that's not a big deal. So we believe taking full advantage of anything in that area is a good deal right now based on history. Okay. So these are ways that you can look at how your income is affected by RMDs. You go through a proper retirement planning software that will actually show you not just what your income is in terms of needs, right? So this is more right here in terms of needs. I need pension and I need to make a withdrawal from my TSP in orange here before my Social Security begins at 67. I need that to live. But at 73 years old, if I see a significant increase to what I'm withdrawing out of my plans, that's no longer needs. That's forced withdrawal. That's requirement, right? That's where you've gotten yourself into a little bit of a jam. All right. And these are things that can be looked at. So I alluded to the QR code that we would share. We've got the ability to get you guys in for a Zoom meeting if you want to discuss this. We are filled up for the next couple weeks. We actually fill up usually about 5 weeks ahead. So what I would recommend if you are interested in doing this, we've carved out a few days on each week for your session to get yourself an appointment. Once those fill up, will be filled up for a couple months. So it's about whether this is an immediate thing you want to look at. If time's of the essence, you're getting closer to retirement or whatever that is, I would get on this immediately and at least get your session booked today so that you get a slot within the next few months. These are all of the things that we can discuss, whether it's Roth TSP, whether it's taxes, whether it's Social Security, whether it's your Medicare premiums, anything that's on your mind could be discussed. Ask that you fill out a small questionnaire so we can make best use of that time. And then we go from there. So Lastly, I'll just talk about before I share my QR code for where the recording will be. If you're looking at a financial advisor and that person is giving you financial advice, go and look at their background on brokercheck.finra.org. Look to see if this person is a registered investment advisor, if they're giving you investment advice. If they are not, they cannot be a fiduciary because they only get compensated by transactional movements like selling you insurance products, annuity products. You do not want someone in your corner that's going to be only making their compensation that way. So you've got to look for a RIA. That means fiduciary. Whoops. Check for certifications, higher ethical requirements, generally by folks that are certified financial planners as well as other designations. Do they have federal government backgrounds is a huge one. Okay. I would highly recommend that. We meet with other clients that have been working with other planners that have no federal background. The advice is usually misguided. Okay. And it's no detriment to that planner. It's just that they don't have the background. So look at all the things that impact you in your planning. And that goes from health insurance considerations all the way out to taxes. So here are all the QR codes. So right here in the middle, we've got the QR code again to sign up for the one-on-one. Do so at your own voluntary. This is completely voluntary, guys. Okay. That is a free session for your first session. If not interested in the one-on-one right now, but you're interested in following us on YouTube, you want more information than what was just given today. In fact, we're posting 5 videos on the Medicare dilemma, right? And you're thinking about what to do there. Follow us on YouTube. You'll subscribe to our channel. Every single week, we pop up a new video about a federal employee related topic. That's a great way for you to stay informed. So if if that's all you do today, that's a win. But if you want to take this a step further, you've got that one-on-one sign up.